If you had to give 3 tax tips for a business owner, what would they be?
My advice would be you need to talk to me before your year end.
Yeah.
Because now we're going to have to wait another 12 months for you to get the benefit of spending any cash.
Yeah.
But I think consider whether there's any assets the company needs that you can spend some money on if you've got the cash flow there to buy an asset that may help you move into a different area within that business. Is it going to generate a new revenue stream for you, or is it going to make your current processes quicker, allows your staff members or you more time to generate more income, do the things you do?
Okay.
And so I'd consider that purchasing assets.
So I think actually, if we just step back slightly, people need to be asking themselves whether their accountant is inviting them in for a pre-year end meeting, and if not, how are they doing what's best for them? I know, speaking to someone earlier today, they were concerned that, they were concerned about what's happened last year and looking backwards. And I said, no, it's not about looking backwards, it's about looking forwards. Because the fact is, we can look back and we can go, do you know what, we can do this better, we can do this better. But we can't change what's happened. Mm-hmm. We can only change what's going to happen. We can only change what's in front of us. So actually, if your accountant's not giving you the opportunity to change what's in front of you, you need to sit down and have a word with them and say, I don't think you are giving me the best options here, because you're not ensuring that I am doing what's most tax efficient because I've got time to do it.
Absolutely, because you need that time to be able to reflect and put things in place before you get to the year end to get it that expense or whatever.
Yeah, so obviously we've looked at some tips there. I think there was only 2, so maybe just give me the third one.
Another tax saving tip may be to consider paying money into a pension for the directors, which we could help a client do that by putting them in touch with an IFA to help them.
Absolutely. Obviously, any tax saving idea is absolutely fantastic. And essentially, when we're sat down in those year-end meetings with people, we will do whatever we can within the realms that are possible to help people with their tax savings. So obviously, we've spoken on the tax savings. What would you say is the most common mistake business owners make with tax?
I would say the most common mistake is people don't plan ahead, which comes in again to pre-year end and planning what we're spending to help save tax, but also not physically saving any cash to pay any tax bills that may arise. Yeah,
absolutely. I mean, the amount of times I sit in a meeting and people have one bank account and I'm like, split them out into pots. Talking in the past about, a car mechanic invoices for £240. Well, first of all, 40 of that is straight off to the VAT man. 38 of that is straight off onto corporation tax, depending on where they are in their profit levels. Whereas actually they might just go, there's £240 for me.
Yes. And then they don't think about it until maybe the accountant gives them the tax bill, and then they have to find it and...
Absolutely. That's obviously for a limited company. What about for sole trader? What tax mistakes can they make?
I would say a similar thing, especially if people aren't aware of payments on account as well. If their tax bill goes over £1,000, they have to make payments towards the next tax year. So that may impact their cash flow, and they're not aware of that. With sole traders and limited companies, you may find where people will use their personal bank accounts or personal credit cards to use for business expenditure, which means it's easily missed. You may miss expenses, but also it's harder to keep track of spending and things. It's a lot easier to have separate bank accounts, separate credit cards to be able to keep track of that.
Yeah, absolutely. Very good sort of cleanliness to keep them separate. Obviously, another common mistake that people do is not tax planning. So whether that's they then haven't got the cash to pay at the time. What are the pitfalls if people haven't got the money to pay their tax, if they haven't saved it throughout the year?
If you're making late payments, HMRC will add interest onto the tax liabilities, so that's another expense you need to find, and also penalties as well. They may fine you for late payment. So VAT late payments, so many times if you're late with a payment, they'll charge you penalties, which again just adds to these extra liabilities that you might not necessarily have the funds for, or you don't need
How do we help our clients then? Obviously, we want to help our clients proactively with that sort of thing. So, we don't want them having fines. We don't have an interest in that sort of thing. So where are we helping in that region?
So we send emails out confirming amounts, reference numbers, bank details for them to be able to make payment, which is the easiest way, really, bank transfer using online banking. So we send that information across so it's readily available for our clients. They don't have to go looking for it.
Great. Now, one massive common mistake that I see when I'm having meetings with clients and would normally call someone like yourself in to deal with is those clients who believe the business bank account is their own personal bank account. And we've got the holidays to the Maldives, we've got the brand new Range Rover in there, we've got the school fees in there, and it comes to year end and suddenly we tell them that they've got an overdrawn director's loan account. So Lucy, just for clarification, can you just explain what a DLA is, please?
So a director's loan account is effectively a current account sitting within the accounts, which any money to and from the business from the directors will sit, because it's likely that at some point the director may have to introduce funds into the business to keep it running, and again may need to take some cash out of the business to maybe borrow or whatever. So this current account is the balance of all of those inflows and outflows. At points it may become, as you mentioned, overdrawn. We need to clear that with dividends, but there needs to be the profits available within the company to issue those dividends, and that's where some people may not monitor that, may not understand, and that's when we get into the overdrawn positions, which ultimately then may lead on to additional taxes.
And actually, again, that is when we need to look at their personal finances to make sure that the business is capable of sustaining their personal lifestyle, their personal wants. And again, that's kind of where we head into, as we would call the advisory space, which is making sure that we are building a business that supports their lifestyle. I always say we work to live, we don't live to work. So Lucy, obviously we're talking about tax and the biggest mistakes people make. Obviously, as always, the government never want to make things easy, so they keep deciding to change the system. So one of the new things, in fact, it's not new anymore. I keep saying new because it's been so long that it's staggered out, but we're still introducing into various things making tax digital. So do you want to give us a little explanation about making tax digital and the future impact on business owners?
So Making Tax Digital has been around for a few years because they first introduced it with VAT. Now they are introducing it for income tax, so MTD for IT as it's abbreviated. So the first wave of individuals that will be impacted are those with self-employment or rental income, so their turnover over 50,000. That will be coming in from April 26, so 26-27 tax year. What this will mean for individuals is they will have to start quarterly reporting. So every quarter, every 3 months, a simplified P&L, so income, expenses and profit or loss, will be submitted to HMRC via a software, an MTD compatible software. So that will be main things like Xero, Free Agent, QuickBooks. So it's important that clients now get on board with this early, I think, to get them prepared if they're not already on the software, so they're ready for when it is mandatory, maybe for 26-27. From 27-28 it will be dropping down to 30,000, the threshold, so obviously that will encompass more individuals. And
eventually it's going to overtake everyone.
Yeah, the government have said by the end of their tenure, which is 2029, they want all individuals with the turnover above 20,000 to be within MTD, so more and more people will be encompassed within that. They will eventually expand it to partnerships. We don't have a timeline for that at the moment. And then I think they will start to encompass other individuals. But at the moment, yes, just over 50 for 2026 onwards.
Okay. So now let's look a little bit about business assets, because there are interesting things at the minute with obviously cryptocurrency, that sort of thing. So we'll touch on a swear word of capital gains tax, and we'll touch on it both from an individual point of view and also from a business point of view. So first of all, just explain what capital gains tax is.
So capital gains tax is a tax paid on gains made effectively of disposal of assets, so it could be shares, it could be crypto, as you mentioned, properties, things like that. It's kind of standard easy ones. Capital gains is generally paid by individuals, different rates. We used to have different rates for residential property and also then other assets. The government have changed that recently, so now there is just one standard CGT rate, one for basic rate which is 18% and one for high rate which is 24%. Also with residential properties, if somebody disposes of a UK residential property that generates a capital gains tax liability, you need to submit a capital gains tax return within 60 days of the sale of that property, and it's within 60 days of actually the date of the exchange of contracts rather than the completion dates, with their different dates, 60 days from the original exchange of contracts, and any capital gains tax has to be paid as well within that 60 days. I think that's the thing often missed by individuals.
Obviously, if we look at another type of capital gains, which is business asset disposal relief, that's got the lifetime allowance of $1 million and has historically always been at 10% for quite a long time now. What's going on with that, Lucy?
So that's been increased, the percentage.
Isn't it?
Yeah, it's going up to 14% from April 2025. So from 6th of April 25 it'll be 14%, and then April 26 it's going up to 18%, and at the moment that's where it will remain.
What we're essentially telling our clients is if they sell their business for £1 million, if they sell it now, they're going to pay £100,000 tax. If they sell it on the 6th of April 26, which is essentially in a year's time, they're going to pay £180,000. So they've nearly doubled the tax liability.
Yes. However, the government are bringing this in line with the CGT rates.
So there's obviously lots going on at the minute with changes in tax rates since the new government came in. What are we doing to help our clients here?
I think there is a lot to navigate, lots of changes, and I think if a client has a certain worry or something they're not sure about, get in contact with us. We can have these conversations, help you plan what do we need to put in place to navigate these changes.
I think planning is the word. I know in a lot of these videos you'll hear the word planning, because if you don't plan, how do you know where you're going? How do you know what you're doing? So if you are coming up to selling in 2, 3, 4, 5 years' time, now is to have the conversation, because actually, let's say you were planning on selling in 2 years, you might change that to, right, I'm going to sell in 1 because I'm only going to pay 14% rather than 18%.
Yeah.
So it's all about, and we say we want to be a trusted partner for our clients. It's all about them communicating with us, talking to us, discussing that plan to make sure we know where they're going, how they want to get there, because we can say, right, do you want to say 4% of £1 million? Which, do you know what, might not sound a lot until you say it's £40,000. So I do think that is really, really important.
And important as well to ensure these individuals will be eligible for business asset disposal relief.
Yes.
Because there's certain criteria that need to be in place for at least 2 years as well. So things like that do need to be discussed in advance.
Brilliant, thank you. So obviously tax is an inevitability. Death and taxes, the only two things guaranteed in life. We've spoken about business owners, and there are lots of business owners, from sole traders, partnerships, limited companies, all of that. Every element of business needs some form of plan, some form of strategy. So obviously we would work with them to help with that, but what can they do to make their tax strategy more robust and more efficient, essentially?
I think it's important, as you say, to plan, make sure there is a strategy in place, and talk to us as their accountant. I think a big thing to consider for directors, let's say, is how they structure payments for themselves, to make sure it's the most tax efficient way to do that. So splits between salary and dividends, and we can have that conversation with individuals, their individual situations, to see what the best split for them would be.
So actually thinking about your trading style is really important, whether that is sole trader, limited company, partnership, because each one of those has different tax benefits, essentially.
Yes, yeah, and it might not just be about the tax as well, so you may need to have that wider conversation. What's the plan for this business, etc., because tax isn't the be all and end all of business setup. Yeah.
Obviously, Lucy, we've kind of said how we help our clients navigate the waters of tax and that sort of thing. We've mentioned lots and lots of tax things, tax strategies and that sort of thing. So let's get down to the most 3 important things that we do with our clients in order to make them as tax efficient and make their tax strategy as beneficial as possible?
Number one, I think, is to make sure there's a plan. As we mentioned, it's very important to be proactive with these things, ensure a plan is in place before you get to year end, for example.
Absolutely. As we said with pensions, there's no point reacting on the last day and try and put the money into that pension. Whereas if you plan for it 3 months in advance,
yes, exactly. You don't want to be reactive. You want to have that plan in place before you get to that point to ensure we are being as tax efficient as we can be, considering assets, as we mentioned as well before. We need to get that in place before we get to year end. Number two is plan your tax liabilities, ensure you're aware of when deadlines are and how much you need to save to get to that point.
And I've always said my favourite idea with that is have your different pots to put your VAT in, to put your corporation tax in. Yeah. Even at home, if you're a director and you're going to have a self-assessment liability, or a sole trader, is have a separate account to put that tax liability into, so it's never a surprise.
Yes, and you're prepared when you get to that point.
Yeah.
Number three, ensuring you have the correct trading vehicle set up to run your business tax efficiently or otherwise.
Absolutely. So that's whether you're a sole trader, limited company, partnership, that sort of thing, to make sure you're running as tax efficiently as possible, and from a personal point of view, paying as little tax as possible. Obviously, part of sitting with our clients through every meeting we do with them, tax included, is about basically getting them the business they want, getting them the life they want, so that they can enjoy everything and be in a much better position than when they were with the previous accountant.